All right, it is 11 o'clock. Good morning. Let's go ahead and get started. We don't want to be respectful of everybody's time. But thank you, and welcome to our exclusive webinar for tax strategies for oil and gas industry. Thank you again for joining us today. My name is Tim Lucio. I'm a wealth advisor here at Saxon Financial Group, and I'm going to be moderating the webinar today. As we get started, and as we were thinking about developing this webinar, we were thinking about the complexities of retirement and, how it's more than just investments. And as somebody approaching the next chapter in their life, you realize there's a lot of things to think about. And it's normal to have worries, to have questions about what's upcoming. And one of the big ones that we really want to address is how to pay less in taxes and make the most of your savings. A lot of times that's actually more important than portfolio returns. It's how do you reduce the tax burdens and plan for a future with confidence. And that's what we do here at Saxon. We're dedicated to helping people transition into retirement smoothly and get the most out of every opportunity. And that's what we're going to be doing in today's session. We're going to give you some practical insights and strategies how you can build a confident and tax-smart retirement plan. Our Director of Financial Planning, Oscar Castro, he's going to be covering some key fundamental tax strategy topics in detail. It's going to be good. If you have any questions during the presentation, please free to type them in the chat box, and we'll answer them along the way. But we'll also have a Q&A at the end. But before we jump into the presentation with Oscar, I'm excited to introduce our Chief Operating Officer, Jacqueline Gilbert. She's going to share a little bit about who we are as a firm, our commitment to your success, and how we work side by side with clients to create clarity and confidence around tax planning, estate planning, investment planning, all for your retirement. So without further ado, I'll hand it over to Jacqueline.
Thank you, Tim. Welcome, and thank you for joining us today. My name is Jacqueline Gilbert, and I have the privilege of serving as the Chief Compliance and Operations Officer here at Saxon Financial Group. It's truly an honor to be with you as we dive into a topic that I believe is not only incredibly important, but also deeply impactful for so many individuals. Before we begin, I'd like to take a moment to share a little bit about who we are as a firm and the kind of service that you can expect from Saxon Financial Group. At SFG, our mission is simple yet powerful: to organize, optimize, and educate. We are a comprehensive wealth management firm, and our approach is designed to address every aspect of your financial life, from analyzing how your accounts are positioned and invested, to uncovering your true goals and objectives through financial planning, and then to memorializing your wishes through estate planning. We're here to guide you every step of the way. But we don't stop there. We believe in preparing the next generation, educating them on their roles, and helping them understand what it means to inherit wealth. Through collaboration, guidance, and mentorship, we empower our clients and their families to feel confident in their financial decisions. Our focus is on financial health, literacy, and legacy, not just for our clients, but for the generations that follow. So how do we achieve all this? Well, it starts with our dream process. It begins with a conversation. We want to get to know you, your values, your current financial situation, and what truly matters most to you. Then we take a look at your goals, starting with your needs and how to address them through current investments or future savings. We also explore your wants and desires with the ultimate goal of helping you achieve all three. Next, we evaluate your current course and make adjustments as needed to better align with your goals. Then comes action planning. This is where we put your plan into motion, focusing on achieving your objectives. And then finally, we continuously track progress, making updates as needed. We recommend reviewing the plan at least once a year to ensure it stays on track. So why choose Saxon Financial Group? Well, for over 20 years, we've had the privilege of serving many oil and gas professionals, helping them navigate their financial journeys. Some of our clients are just now entering retirement, while others have been enjoying it for 15 plus years. What sets us apart is our dedicated team approach. Each client has a team that includes a wealth advisor, relationship manager, certified financial planner, and operations specialist, all working together to provide personalized guidance and support. We are also proud to be a fiduciary, which means we are legally obligated to act in your best interests. When you succeed, we succeed. With that, I am thrilled to introduce Oscar Castro, our certified financial planner, who will be leading today's discussion in tax strategies. Thank you again for being here, and we look forward to an engaging and insightful session.
Thank you, Tim. Thank you, Jacqueline. So good morning, everyone. Again, my name is Oscar Castro, Director of Financial Planning here at Saxon Financial Group. And today we have plenty of items that we're going to go through in this presentation. So one of the priority ones is cash flow, more specifically when we're talking about tax efficient withdrawal strategies when it comes to retirement, but also some other tidbits here, net unrealized appreciation. So being able to leverage the company stock if it is within your retirement accounts. And then looking at the dreaded lump sum versus pension annuity that some clients, you dread over like which option is best. And we'll go through kind of some of the overviews and kind of the considerations when it comes to that. And so to start, we want to kind of go with tax efficient withdrawal strategies, as this is basically the bread and butter of your financial plan, right? How are you going to build that income during retirement in order to benefit you long-term tax efficiently? And so I want to start off with the three buckets, right? So picture your retirement in three different buckets. So here we have tax-free, tax-deferred, and taxable. So each of these buckets are taxed differently, which means the order in which you pull from these accounts affects how much stays in your pocket in terms of taxes. And so for each of these, we'll cover a breakdown of how each of these work, how do they affect your taxes, and what does it mean in terms of creating your retirement income. And so the first bucket, tax deferred accounts. So most of you are probably familiar with this. So it's usually your 401k, your traditional IRA. And for these, you make pre-tax contributions. So just like during payroll, this usually gives you an immediate tax savings, right? Because you're delaying that growth and taking the immediate tax savings now. And then with the growth, it's tax deferred. So once you contribute to these accounts, any growth is accumulating over time, and there is no annual taxation. But when it comes to withdrawals on these accounts, so like 401ks and IRAs, you could think of it as like taking a paycheck, because every time you receive a distribution from these accounts, they're going to be taxed at the ordinary income tax brackets. And as we can see here on the far right-hand side, it ranges from 10 to 37% in terms of the taxes you might pay, but it depends on how much you're taking from these accounts. And then the more you take, the higher the tax bracket you'll be in. And then there's the dreaded RMDs. So if you do have big qualified accounts, there's something called RMDs, required minimum distributions. And so depending on when you were born, typically right now is age 73 to 75, you're going to be forced to pull money out of these tax deferred accounts. And it does pose, a tax bomb question in your plan is, do you have a lot in qualified? And if so, we want to kind of factor those in, because RMDs can push you into new tax brackets. And that's where we kind of want to discuss that tax efficiency. And then next is taxable accounts. So typically your brokerage accounts that you set up, these are made with after-tax contributions. So these are already taxed. So whenever you receive your net pay from your job, if you put anything into this taxable brokerage account, well, it's already been taxed. There is no tax benefit when you do that contribution. But there is, a slight negative to these accounts, also known as kind of leaky buckets, because dividends, interest, income, and capital gains that are generated from this account is taxed annually, right? Instead of a qualified account, which is tax deferred, all the growth is just growing deferred until you pull it. But taxable accounts, they will get paid, you will pay annual taxes depending on the investments, right? But when we look at the brackets on the far right table, we can see that the capital gain rates for brokerage accounts or taxable accounts are 0 to 20%, so way less than the ordinary income tax brackets. And so this is a good combination of accounts to have in order to be flexible during retirement. And then with the flexibility, there's no contribution limits, there are no income restrictions. They receive a step up in basis, meaning if you do have a brokerage account and you do pass away, whoever inherits it gets the step up in basis, meaning whatever the fair market value was at that time, if they go turn around and sell it the next day or that same day, there is no tax consequences. And then being aware of having tax efficient assets in these accounts, right? Because again, it is a leaky bucket. It does get taxed annually. And so having instruments like municipal bond index funds in there is a lot better than just having heavy income producing funds. And then we do have the Roth account. So this is now implemented in kind of the 401k portion. So there's a Roth portion, and then there's just the traditional Roth IRA. And these are after-tax contributions. And so just like the taxable account, there is no technical tax savings then. But what it allows is that it also has that tax-free growth and withdrawals. So meaning if you contribute to this account, it's after tax, but all the growth and interest accumulated over the years can be pulled out tax-free, as well as the growth you're not taxed on it annually like a taxable account. And then for these accounts, there are no required minimum distributions, so you don't have to worry about that issue down the line when it comes to retirement where you reach a certain age. You're not forced to pull from this account, though this is an account that can help with strategizing kind of your tax bracket and making sure we're kind of staying within a certain range in order to be tax efficient through your retirement. And then I kind of want to let you know from a traditional standpoint, the conventional withdrawal strategy. Usually when individuals come and they say, well, I can just pull from my taxable account and just pay the 0 to 20% in capital gains, right? Way less, bigger brackets. And then I'll just dip into my tax deferred accounts and then my tax-free accounts. So again, think about it as just your taxable account brokerage, and then your IRA, and then Roth. So there are some limitations to this conventional wisdom, and that it's all obviously not one size fits all, but by delaying the withdrawals from your qualified accounts, remember that is that RMD factor. And so that is growing in the background. And so that could push you into a higher tax bracket in the future. And so we don't want to necessarily wait until a tax bomb happens to make a change, right? And then ignores opportunities for tax optimization, right? Because in the lower brackets, we can at least take advantage of those with qualified assets, and then anything on top with taxable accounts in order to be more tax efficient throughout your retirement, not necessarily front loading the savings in the front end and then paying more taxes in the back end. So, and then, like I said, it's not just a set it and forget it strategy. Annually, things change for yourself, but also laws change. So just because the strategy may have worked in the past or for some individuals, right? It's unique to every individual. We always want to be keeping up with legislation as well as changing dynamics in your life. So it's not a one size fits all. And so this is where we'll kind of cover what do we mean by tax efficient withdrawal strategy, right? And so we'll kind of go through an example. So here we have Jerry and Michelle. So they're both in their 60s, right? They have an income need of about 100,000 in order to bridge that gap until they take Social Security, and they have a portfolio of about 1.5 million. And so this is the breakdown of their accounts. So it's traditional IRA, taxable accounts, and the Roth. And so what we're saying now is that they need $100,000. Well, first we can pull 31,500 from their IRAs, and then you may be wondering why specifically that number. Well, because in 2025, the standard deduction is 31,500, meaning if you do have any ordinary income up to 31,500, you pay no taxes because of that standard deduction. Now, your standard deduction might be higher if you do itemized, right? If you bring in mortgages, interest, and all that. But in this example, 31,500 is what we're taking in order to wipe it out with the standard deduction, which means there is no taxes due on this amount. But we still need to make up the difference. And so here is where we'll tap into their taxable account. So here we're going to pull about 68,500. And then as you notice, for the 400,000, there is a 60% basis, meaning that 40% of it, any amount that we pull, is going to be taxable. So of the 68,500 that we pulled, about 27,400 is going to be taxed at long-term capital gains rates. But the beauty of the taxable accounts and utilizing the standard deduction is that for the 0% tax brackets for married filing jointly, they would have to reach 96,700 of taxable income in order to pay taxes. But since they're below that threshold, right, they're generating 27,400 in capital gains. That's way less than that 96, which means they're paying zero taxes on their capital gains from withdrawing from this taxable account, which means all in all, they pull from their IRA, they pull from their taxable accounts, and they managed to get 100,000 tax free. And so by understanding like how the distribution sequence works across your taxable and IRAs, and including Roth, there are periods in which if you need to pull a big amount, Roths can be helpful in that sense. But this allows you to be flexible and as well as control your taxes throughout retirement, not just rely on just a standardized strategy, which doesn't optimally work each and every year. Again, this is a changing, ever evolving situation. And so it's best to look at your unique situation, but we want to make sure that you're at least utilizing all the books that you have at your disposal. All right.
All right, Oscar, we do have a question. What kind of investments are better for taxable versus the tax deferred accounts?
Yeah. So typically for taxable accounts, like say again, since it's a leaky bucket, we don't want to have any heavy income producing assets in there. So typically like bonds, REITs, we don't want to include in there. In the taxable accounts, we probably want to shift those into the qualified because it's tax deferred, you're not taxed annually. For taxable accounts, we want to make sure we have more, tax friendly investments. So like ETFs, individual positions like stocks, where some of them don't pay a lot of dividends because again, if they do pay a lot, you're going to be paying taxes annually. And so that's kind of how you would want to break it out. The more tax efficient investments like ETFs and stocks in the taxable accounts, and then those income producing assets, we want to make sure we put them in qualified assets, whether it's IRAs or Roth, just to make sure that, we're being as tax efficient as we can with the investments and also the strategy in which you pull from them. All right. Hopefully that answered that question. All right. So now that we laid kind of the framework or the groundwork for kind of the different buckets, some of you may not have the flexibility of that, but what we'll talk about now is kind of it can help both in diversifying your retirement buckets, but also helping you in retirement in terms of income distributions. And so with net unrealized appreciation, this is specifically focusing on your employer stock that is contained in your retirement portfolio at your work. And so what is net unrealized appreciation? So when you look at it, if you have your 401k, for example, and you bought company stock within it, right? The price that you paid is called your cost basis, right? How much you paid for it. And then hopefully, right, once you buy your employer stock, you would hope that it would appreciate in the future. Everyone does, right? And if it has, so what we would look at is the fair market value of the time that we're going to execute an NUA, and then your cost basis. And the difference between those, it's called your net unrealized appreciation. In term, just appreciation on your employer stock. And so the beauty of net unrealized appreciation and why it matters is that we're able to take your employer stock from your qualified assets. Remember, that's taxed at ordinary income tax rates. We're able to pull that amount out and put it into a taxable account that will allow you to pay long-term capital gains rates, which are way lower than ordinary income tax brackets for future distributions. But there are caveats and requirements in order to execute on the NUA. And so we'll kind of look at the traditional method that most clients do, and then we'll look at the NUA and how it benefits those with employer stock. So the first and original, most clients, when they do retire, they roll over most of their assets to an IRA. So here we just have a simple 401k made up of, maybe mutual funds, ETFs, non-employer stock, but then they also have employer stock within their plan. But typically, most retirees, they just do a direct rollover. And when they roll it over to their IRA, we got to remember it's taxed at ordinary income tax rates and range from 10 to 37%. Now, with the NUA process, we're still moving those non-employer stock positions to an IRA, right? that's still the same case. But when it comes to the employer stock, this is where we're wanting to transfer it in kind into a taxable account. Now, here's the caveat to this is that the cost basis, right, of that stock, you are going to pay ordinary income tax in the year you elect the NUA. But any of that future appreciation, that NUA, when you go to sell it, it's going to be taxed at long-term capital gains rates. And then going forward, any appreciation after that would be the same case, depending on the time frame in which you hold the stock out. But this allows you to pull your employer stock out of your qualified assets to avoid paying ordinary income taxes, well, the full amount in the future, putting it into a taxable account so that later on you'll pay long-term capital gains rates. And so we'll kind of go through an example of non-NUA and NUA. And so here we're going to use Mark and Lisa. So Mark has a stock value in his 401k of about 400,000. We know that his cost basis in the stock is 100,000. So we'll do that math, 400 minus 100,000. He has an NUA balance of 300,000. So we know that in the future, now and in the future, they're going to be in the 24% tax bracket. We're also assuming that in the long-term capital gains rates, it's going to be at 15%. And so when we look at them side by side, we'll kind of see why the NUA makes sense in this situation. So again, we have the value of the company stock at 400,000. We have his cost basis at 100,000. And so remember with the NUA, we have to pay taxes on the cost basis. Well, since they're in the marginal tax bracket of the 24%, they're going to be paying 24,000 in order to elect this NUA, right? And then any future distribution of the same amount from the stock when it's transferred to a taxable account, all of that is taxed at long-term capital gains rates, which we said they're paying at 15%. So all in all, the total taxes paid is 69,000 for the NUA strategy. But what if instead you just rolled it over to your IRA? Well, we still have the same assumptions here. 400,000 is the value of the company stock. The basis is 100,000. But remember, everything you pull from your qualified accounts or IRA, it's taxed at ordinary income. There is no long-term care, sorry, I keep on saying that, long-term capital gains. So here, it's the full 96,000. And so when we look at it, 69,000 for the NUA, non-NUA is 96,000. We're able to get a savings of 27,000 by electing to do the NUA. And it works because his cost basis is pretty low. Now, just because you have employer stock doesn't necessarily mean it's always right for you, because we can look at an example if he had a high cost basis, right? So the same thing, instead, we're changing his basis in the employer stock to 300,000. And so from there, we can see that the tax savings drops tremendously. I mean, there's still a tax savings, but now it's 9,000 instead of that 27,000. So meaning we want to make sure we elect the NUA with low cost basis and highly appreciated employer stock. But if your cost base is almost the same as your stock, it just does not make too much sense to do that. But there are also qualifying contexts to doing the NUA, right? So there's triggering events. So typically it's separation from service, reaching age 59 and a half. And there's other ones like disability or death. So your beneficiaries can't elect to do the NUA for you when you pass. Neat trick there. And then lump sum distribution. So when you elect to do the NUA, you got to make sure that, at least in this context for your 401k, for example, you want to make sure that the whole balance of that account is distributed out. Again, the non-employer stock going to an IRA, and then the employer stock going to a taxable account, making sure that you do your best to zero out that account. And then in-kind distribution. So when we say transferring stock to a taxable account, it has to be in-kind. You can't necessarily sell the shares in your employer plan and then transfer cash. That nullifies the NUA. So you want to make sure we keep it intact and then transfer it in-kind in order for this to work. And so other key points to consider when doing the NUA is, like we mentioned, low cost basis and highly appreciated, and then current tax bracket, right? If you have a bunch of qualified assets, correct, and you have an RMD problem in the future, well, if you do elect the NUA now versus if you were to wait, you will probably take advantage of that tax arbitrage, and paying the taxes now is lower than if you were to pull from your qualified assets. And so for those who don't have any, diversified buckets, this could also create a way to diversify your buckets. So you're able to pull your employer stock out into a taxable account so that in the future we can kind of do tax efficient withdrawal strategy, right? A combination of your qualified and your taxable account in order to be more tax efficient. And then for those, this kind of applies to those who separate 55 or later. You're able to tap into your assets more. Well, you're able to tap into them because traditionally you have to wait until 59 and a half. But if you separate from service and elect the NUA, you're able to pull that employer stock into a taxable account, which you can use before you reach 59 and a half. So kind of like a bridging that gap. And so if that's a situation you kind of see yourself in, NUA does kind of make sense in that scenario. But again, we have to look at the whole picture, not just solely focused on the NUA itself, but other income sources that you have and where you are in the tax brackets.
All right, Oscar, we have another good question. Is there should they expect any potential penalty with a NUA strategy?
Yeah, so there is a penalty for the NUA strategy when you do it if none of the exceptions apply to you. So like separating from 55, for example, you're still working. There is that penalty, but the penalty is on the cost basis, right? It's not the whole amount of the employer stock, the value of it. It's just the penalty on the cost basis, because again, you have to pay taxes on the cost basis when you elect the NUA. And that's usually only if none of the requirements that we talked about before, follow through. So reaching age 59 and a half, separating from service at 55, there is the potential for that penalty. But other than that, there shouldn't be any. All right, here we get to the meat and potatoes. Usually for most clients, making the financial decision to kind of see what makes sense in your case. And so when we go through this, we'll kind of look at an overview of the pension plans noticeable in the oil and gas industry. But this is one, it could be number space and also psychological. And so we'll kind of touch on the considerations, but ultimately each person is going to be unique. And so the common pension plans that we do see in oil and gas, right? The majority is usually a defined benefit plan. So these are usually calculated based off salary and years of service. So this one is more so calculated like a pension annuity. And then there's other plans that are cash balance plans, which are more like a 401k, where you can see your account grow, and it's calculated more on an account balance perspective, not like a monthly annuity, more so like an annual benefit or like a lump sum. But then there's also hybrid plans, which take into consideration both, where maybe there's a cash balance plan that doesn't utilize credits, but utilizes years of service at a certain amount, and then you get a certain percentage based off of your age. So there's different hybrids in the oil and gas industry, but for the most part, it's usually a defined benefit plan, the traditional method, which is based off your highest salary and then years of service. And so we can kind of touch on those here, where the traditional pension method is just really earning based service recognition, and then some Social Security offset, right? Because most of these pensions are not necessarily supposed to be on top of Social Security. And so that's why they factor that in to back into your annuity that they would be paying you. Now, for most traditional pension plans, they usually have various vesting requirements. So some of them require a combination of age and the years of service. Some of them, like the cash balance plan, which we'll touch on, is just solely years of service. But for the most part, this is kind of the pension plans that most oil and gas individuals participate in. And then there's also early retirement options, right? So as I mentioned, it still has to meet a certain amount of years of service and age. So for one example, one is 55 years old, but have worked for 10 years. And so that is just to be able to be vested into the plan, but doesn't necessarily mean you would get 100%, because there are plans that reduce your benefit based off of your age. And that's one thing to consider when you're looking at your pension plans. And for the cash balance plan, so this one, like I said, is mostly noted like a 401k style. So this one relies on interest rate credits. So typically some plans use the treasury, the 30-year treasury. It's also based off of your pay, sometimes annually, sometimes a monthly calculation, and then age-based pay credits. So depending on the age that you are, there's a certain percentage that your employer allots to you in order to calculate your benefit. And the difference between the cash balance and the traditional is that the traditional is always calculated like an annuity, right? And then to back into the lump sum, we have to do a little bit of math behind that in order to get that amount. But for the cash balance plan, since it's almost like a 401k, it's like a balance that you can see. These are typically quoted in a more lump sum basis, and then you can transfer it into annuity-like. And so here's kind of the payouts that most pension plans do. So single life annuity. So this is just a single annuity for for one life, right? You. And so these are monthly payments. So there's sort of a guarantee in these aspects. And so, but when you die, right, if you did take a single life annuity, well, that means that those payments stop, right? So it's usually bigger, right, if you elect a single life annuity. But when we factor in joint survivors, that's where we'll see a reduction. And so for the joint survivor annuities, usually typically with spouses, they range from 20, 25, 50, 100% in terms of how much you're wanting them to receive if you were to pass, right? And so typically we see couples elect the 100% survivor. So that meaning that you will take a reduced annuity benefit right up front, but your surviving spouse would get the benefit of that continuation, right? And so that's where the joint and survivor annuity come in. We're planning on 2 instead of 1. And then there's the lump sum option. So again, for traditionals, we have to back into it in order to get that lump sum. But this is just like it's noted, a lump sum payment that you can directly, usually just roll into an IRA. And then from there, you're able to distribute how much you want. You can invest it how you like. But for these other 2 options, again, it's just a single life annuity payment that's to you. Some of them might have inflation protection, but some of them more than likely they don't. And so it's just that same payment for the rest of your life versus the lump sum here. But the tricky thing about taking the lump sum is that certain plans are, they need to consider the rates at the time you're making the decision to commence your benefits, because we can see here on the left-hand side, we can see that as interest rates rise, your lump sum decreases, right? And we can look over here on this graph on the right, where we can see the recent trends, right, in interest rates. So we are seeing a trend downward, right? We're seeing the Feds trying to cut rates. And so obviously we're not in periods of where 2020, where the rates were low, and so your lump sums were pretty big. But since then, rising inflation made the lump sums decrease, usually by 8 to 10% per 1% of increase in interest rates. And so, but we are seeing a trend go down. But this is something we consider when taking the lump sum is kind of, are you benefiting now, or is it better to wait a little bit once interest rates drop so you can get a boost in your lump sum? So these are certain things that you want to consider when thinking about the lump sum, and not just the comparison between lump sum and annuities. And so here we have some choice considerations, right? So things that favor the lump sum, right? You want control over the assets. So investments and being able to spend, being able to distribute how much you want. And then there is some inherent inflation protection because, the markets have been designed to beat inflation over time. And so versus an annuity where it's just fixed payments, and some do have that inflation adjustment, but the majority of them don't. And then legacy. So if you did, for example, take a single life annuity or even the joint survivor, and you take it for like 5 years, and then the next 2 years, both of you pass, well, there's nothing left to pass to any heirs at that point. And so with the lump sum, at least you have a bucket so that you can pass down to your children. And then spouse, again, this is really just protecting the spouse through ownership So if you pass, the spouse will inherit the account. And so this is also another thing where it comes with legacy and planning for not just yourself, but for your spouse and children. And then for the annuities, right, this is more so guarantee instead of, being scared of the market, or you have a spending habit and you want to be able to be strict on that. The annuity does work in that favor because again, it's a fixed payment that you're going to be receiving. And there is no investment risk, I would say, but there are people or companies that will protect the pension if anything does happen. But if anything, it'll probably be reduced. But there is some sort of guarantee there when taking the annuity. And then it's simple, right? You just select it, you get your payment, and then you don't think about it, right? Versus if you did take the lump sum, managing the assets and the proper investments, but you can also utilize like us or someone else to kind of facilitate that for you. So that does also bring peace of mind. And then longevity. So if there is a risk in your family that you do live long, well, it's not a risk, you would hope so, right? But in the annuity, you can at least, know for sure that over time you're still receiving your payments, I'll bet just without inflation adjustment. And so that will work in longevities because again, if you do spend heavily with the lump sum, well, then it's kind of gone at that point, right? Versus the annuity. And then spouse. So again, spouse is kind of the same for both. In this case, it'll just be a survivor option. And so versus the kind of an asset ownership of the lump sum when you pass. And so choosing between kind of the both of these is more so a highly personal decision, right? Each option comes with its sets of trade-offs, but like we know, most clients in the industry, especially during periods of lowering interest rates, the lump sums do make more sense. But if there is, an aspect of your spending or fear of, longevity, annuity comes into play as well. And so not only that, but there's also the kind of numbers like which one makes more sense in your plan. And so that's where we kind of come in to kind of give you the outlook of kind of what your retirement would look like with both of these scenarios and which one benefits you the most. But math is math, but also there are psychology aspects to this, right? And so we want to make sure that you're comfortable with the decision ultimately that you make. But again, it's highly personal and dependent on each of your unique situations. So managing investments, some people don't like, others do. So stuff like that you have to consider that's right for your family and the legacy that you kind of want to leave.
All right. Well, that wraps up the main part of our presentation. Thank you again for your attention and participation so far. If you have any last remaining questions, please go ahead and type them into the chat box, and we'll do our best to answer them. So it does look like we do have one last question here. And I know you talked about this. We're going to go back to the annuity because it says, how would you which one would you choose, lump sum or annuity? I know we just covered that, but thinking about it, Oscar, what would you say drives it? One of the primary things that drives making that decision between lump sum and the annuity.
Yeah, so it still varies from person to person. I think it's more so of their tolerance for risk in terms of investments, right? Because with the annuity, you have peace of mind, right? I feel like peace of mind with the annuity is a strong factor for some clients, especially since they have something coming in. It does reduce kind of the flexibility in terms of tax planning, but for most, when it comes to the lump sum, you can almost sometimes get the same rate or better in terms of getting an annuity versus investing in the lump sum. So it's factors like that in terms of age is also one. And then again, we just look at longevity because when it comes to that, it might make sense. But then again, lump sum's always there. If we're investing conservatively, we can kind of match similarly to what an annuity might do. And so that is a peace of mind there. But a lot of individuals are different, but also interest rates, right? Because as we saw in 2020, interest rates were low. but now it went high and then now it's dipping down. So lump sums are looking more attractive because, you're getting a bigger bump in your lump sum than really the annuity.
Yeah, no, that's a good point. And it is such a personal decision, and there's a lot of aspects to that, and that's something that we could definitely help you. You don't want to make that decision on your own, and that's something that we can help you with and walk you through and find out all your specific situation, your goals, your objectives, and help you make that really big, important decision. But again, we want to be respectful of everybody's time, so thank you again for joining us. We understand it's a lot of information to consider. There's a lot of complexity when preparing for retirement. So, we really want to encourage to ask yourself, are you starting to prepare now for that next phase of life for you and your family? Or are you just hoping that everything is going to work out once it happens? We see that a lot in this business, and you definitely don't want to wait. You want to get and start working on it now, start preparing for it now, because if you don't, you're going to end up paying the tax man a lot more than what you really want. And we can help you with that. We can help you with the next steps taken towards your financial confidence. We encourage you to schedule a complimentary consultation, and we can work on your plan, see if your plan is ready for the years ahead. We'll help you every step of the way. We can go over specific strategies for you, and just really show the value that we can add to your retirement plan. Here's our contact information. A QR code will connect you to our calendar. So feel free to reach out to us, schedule an appointment. And also, just so you're aware, we do have another webinar on December 17th, and it's going to be on estate planning, which really rounds out the retirement series. So check your inbox for that appointment link. You'll be getting from Ryan Lunn, and that's going to be upcoming in the next couple of weeks. Again, thank you for joining us, and we really look forward to connecting with you soon. Thanks.